It feels that the risk of recession is somewhat being exaggerated. I think this yield curve inversion has really worried people, but actually it doesn't necessarily tend to signal US recession. It's actually bringing in a lot of the weakness from the rest of the world, namely China and Europe. But the US especially, with the consumer so strong, it's difficult to predict recession for 2020 at this stage.
So is it fair to say that the yield curve inversion, brief as it was, is it just a non-event, or is there really cause for a concern because it may not portend for a 100% recession, but it's still something that the bond market is signaling to the rest of the economy and the traders on Wall Street about what could happen?
Well, I think given the strength of the signal previously, it has managed to predict 7 of the last recessions. So it's too strong to completely dismiss. We have to be acknowledging the fact that in the past, there were different factors. So now we have a lot of structural factors such as pension fund demand. We have quantitative easing from the last 10 years. And these things are all pushing down the longer end of the yield curve, which means inversion is a lot easier to happen than previously. But if you look at the economic data, which I think is key, that would suggest to us that recession, the risks have increased, absolutely. But absolutely, it's not our main scenario for 2020.
So what is the main scenario then? Is this a situation, Seema, where we can continue to buy dips? Are risk assets that much more attractive now, given the pullback that we've seen in the volatility? Should we just all be going out and buying tech stocks and communication services stocks and industrials despite the trade war threat?
No, I think it's a little bit too early to be buying the dip still. You know, if you look back at since the beginning of this year, the rally that we've seen in risk assets, mainly in equities, it has been very disjointed with the fundamental weakening in the economy. So although we don't expect a recession, there is certainly a slowdown underway. And it does feel that equity markets need to have a bit of a correction to bring that back down to the right levels. On top of that, of course, we have the threat of the trade war still hanging over us. And that does mean that investors need to be somewhat cautious. So, you know, you should have exposure to equities in your portfolios, but really be positioned more defensively. So defensive sectors, technology does tend to bounce as soon as there is some good news. But when we think about the trade war over the longer run, it seems to us that technology is really going to be the key area where the Trump administration is going to be targeting.
What is the key focus right now for investors and for traders out there with regard to the next leg, whether it be higher or lower, perhaps, like you said, a correction happening? What will be the thing that matters the most, I guess, in most people's minds with regard to how the markets react in the next week or so?
I think for the next week, the key thing to be watching is going to be Jackson Hole, where you'll have Fed Chairman Powell speaking. We are expecting him to signal that there will be another rate cut in September. We are hoping that he will surprise markets to the upside, so showing that he is more likely to cut more than the market is currently expected, and that would certainly help. The other thing to be watching really over the next month or so is actually the strength of the consumer, because that's what's holding up the US economy. If we do start to see signs that the consumer is starting to weaken, then I think there'll be more forecasts out there for US recession.
What signs would you be looking for on that front? Because, I mean, President Trump does have a point. There are a lot of signs of strength for that US consumer right now. However, there could be perhaps flashpoints or economic data points that signal otherwise if we start to see them roll over. What will be the most important economic data to watch on that consumer front in the U.S.?
I mean, there's a couple of things. You need to be keeping an eye on the consumer confidence side. See, we had retail sales, which was strong for August, but I have to say that sometimes it can be distorted by the impact from Amazon Prime. So you're really getting discounters performing pretty well, and that gives you a somewhat more rosy view of the consumer than it should be. So you're looking at next month's retail sales numbers and continued retail earnings figures. You know, a couple of the firms that did report last week were discounters. They perform really well, but discounters' strength suggests to us that the consumer is starting to pull back a little bit. So we need to see more impact from there, and of course, consumer confidence. The other thing to consider is the routes to which consumer can be impacted. One way is tariffs on consumer goods. Now, we know that the last round of tariffs was meant to be focused on consumer goods. So if we get that being introduced in December and maybe hiked from 10% to 25%, that would be a real worry for us. And the other thing is if investors and companies continue to be scared by the impact of the trade war and they pull back on their investment spending decisions, the next step to that is they cut back on their hiring intentions. Once you have that, then you tend to have wage impact, and that's when the consumer starts to weaken. So those are the two routes to a weak consumer that we'll be watching.